Alright everyone, welcome to the lesson video for savings and investment. It's loosely based on chapter 17 and some external articles that I will have linked within the module. So an important disclaimer before we get started. This module is not meant to be taken as financial advice. This is an educational module that I get based off of questions that my students bring me about the stock market and things of that nature. But it's really important to remember that this is really just a broad overview, and therefore you shouldn't make financial decisions based exclusively on what's discussed in this video or the corresponding module. I cannot cover everything in this topic, and you should only take financial advice from professionals who are licensed to give professional financial advice. So some key questions for this topic are: what are some tools to guard against macroeconomic changes, and what are some tools for protecting and growing wealth over time? So first things first, how this can relate to the macroeconomy at large is with this idea called inflation. You might have heard of it before. It can be defined two ways. Typically an increase in the average price level over time, or you could say a decrease in the purchasing power of a dollar. These two things essentially mean the same thing. As the price of everything in the economy increases over time, the value of the dollars that you use to purchase those things with are not worth as much. It takes more dollars to buy the same things as their price increases over time. So this is just the idea that a dollar today is worth a lot less than a dollar did back in 1950, and that the price of most things today, a gallon of gas, a loaf of bread, a gallon of milk, etc., cost a lot more today than it did back in 1950. In the United States, we typically experience annual inflation of about 2 to 3%. It just depends, but it can fluctuate outside of that range year to year. And the Fisher equation helps explain how inflation affects interest rates. So the real interest rate, real terms in economics just mean adjusted for inflation, so real prices, real interest rates, etc., are equal to the nominal interest rate minus inflation. Nominal means not adjusted for inflation, or prices or interest rates expressed in whatever the current price level is. So it's the advertised price or interest rate at a given time. So the way you get from nominal to real is by subtracting out inflation. So what does this mean for your own wealth over time? Well, it means that inflation is working against you. And if you keep money in a checking account, in traditional savings accounts, or in cash, you're probably losing money every year. So assuming that inflation is about 2.5%, right in that typical range that I explained on the previous slide, if you have some money in a checking account, most checking accounts do not pay any interest. So a 0% interest rate. You put money in there, you leave it in there, the same balance that you put in is what you get out of it over time. That means the real interest rate is that 0% minus inflation, and actually any money you leave in a checking account loses about 2.5% value over time. So if you have a $100 balance in your checking account at the beginning of the year, by the end of this hypothetical year, it would be like having $97.50. Now, if you put your money in a savings account, the average savings account rate, according to FDIC, is about 0.05% per year. So you earn a little bit of interest, but it's still not enough to beat 2.5% inflation. So in this case, someone with their money in a traditional savings account would lose slightly less money, but still down by quite a bit. So when I tell my students this and we work the Fisher equation, they think to themselves, or sometimes I get the response that, well, if the checking account and the savings accounts won't work for me, I'll just keep my money in cash. Certainly the banks can't screw me over if I have cash. I'll just keep it in a shoebox under my bed or something like that. Well, no, that's not quite how it works either. Even if you kept everything in cash, you can't escape the effects of inflation. Cash doesn't earn any interest at all, so that's like having a 0% nominal interest rate, and you're still just as worse off if you keep things in cash. So you might be thinking to yourself, well, hold on a minute. I don't see the money in my checking account, in my savings account, or even the cash that I have under my bed or in my wallet losing value every year. It stays the same. How could I possibly be losing money? And the answer to that question is that Remember, the value of money fluctuates over time. It's not valuable innately, it's worth what you can get for it. So as prices fluctuate, that money typically loses value every year, typically between 2 and 3%. To show you a more extreme and funny example of this, I'm going to play a quick clip from Austin Powers. In this clip, Dr. Evil has been cryogenically frozen for the past 30 years, and he has a plot that he's going to explain in this clip to make himself very rich, but he forgets to adjust for inflation.
It's come to my attention that a breakaway Russian republic for Pakistan is about to transfer a nuclear warhead to the United Nations in a few days. Here's the plan. We get the warhead and we hold the world ransom for $1 million.
Don't you think we should maybe ask for more than $1 million? $1 million isn't exactly a lot of money these days. Virtucon alone makes over $9 billion a year.
Really? It's not. Okay then. We hold the world ransom for $100 billion.
All right. So, hopefully that clarified how money loses value over time if you do nothing with it. It doesn't have to be that extreme. It doesn't have to be $1 million over the course of 30 years, but our money loses value year after year. We just don't notice it when it's only a few cents on the dollar. But it is happening, and it would become noticeable over longer periods of time as you try to save and invest over the course of your life, as you try and save for some of those big future expenses. So, some other reasons to think about saving and investing aside from protecting yourself from the costs of inflation is for these reasons. So there's quite a few statistics out there that show that as far as saving and investing go, the average American is not doing so hot. So there's a Federal Reserve survey that shows that 40% of Americans couldn't cover a $400 unexpected emergency expense. That means they would have to either put it on a credit card, take out a payday loan, borrow from friends or family. And that's pretty serious because life is full of little emergencies like this, whether it's your car breaking down, a medical bill, losing your job unexpectedly. It's good to have some money set aside for these financial hardships that inevitably happen in life. Unfortunately, older Americans don't do much better than the average American. Most Americans aged 50 years or older have less than $30,000 saved for retirement. So those are people who are approaching retirement age and maybe have less than what they would consider a year's worth of expenses saved up. That could really be a problem and make it difficult to retire. Going along with that, a more recent study found that 40% of current middle-class Americans are on track to live at or below the poverty level in retirement. So these are people who are currently middle class who simply do not have enough saved up to continue that middle class lifestyle. They're on track to live at the poverty level because they're not saving over the course of their lives. The picture is also bad for women and minorities. More recent studies show that women and minorities are the least likely to prepare for the future to save and invest, especially when it comes to retirement or other things. And this 2019 study linked above shows why. Typically, financial knowledge is passed on from one's parents. It's generational. So if you came from a moderate or a low-income family, those parents are just less likely to pass on savings and investment habits than those who came from wealthier families. Wealthier families probably had knowledge and skills of how to save, how to invest, what those opportunities looked like, and they taught their children. Whereas if you had parents who did not have that type of financial security, they didn't know or have that knowledge and skills to pass on to you. So that's another reason to start learning about saving and investing, is to be better off than the average American, the average retiring American, and break with some of those demographic statistics. So if we're going to understand how saving and investing works, we have to understand something about how financial capital markets work, which is the title of Chapter 17 in your textbooks. Specifically, we're only interested on this first side of the equation here, savers. And essentially what we're talking about here is financial capital markets, also sometimes called the market for loanable funds. And the way saving and investing works is we're connecting two groups of people who want to save or invest money, and then people who want to borrow money. And to connect those two groups of people, we need something called a financial intermediary. An intermediary stands between two groups. So it's an institution that receives money from savers, provide those funds to borrowers in the form of loans, with the hopes the borrowers will pay that money back plus interest. The banks can get some of that interest and also pass some of the interest along to the savers. So banks are an example of a financial intermediary. Some other ones that we'll discuss later in the topic are brokerages. All right, so we're interested in being on the saver side of the market. So as a potential saver or investor, when deciding what to do with our money, there are three criteria that your textbook says we want to consider. First, the expected rate of return, or ROR, it will pay. 2, the risk that that return will be very different from what we expect. And 3, its liquidity. So, with the rate of return, there is the expected rate, our prediction of the profitability of how much an investment is going to return for us in terms of earnings, and the actual rate of return. So this isn't a prediction, this is what actually happens over a fixed period of time. The difference between those two is a good way to think about the second step, or the second criteria, which is risk. So high-risk investments can have actual returns that are either much higher or much lower than that expected rate. And it can, when I say much lower, in some cases, it can be negative to the point that the investor actually loses money instead of gains a return. The last criteria is liquidity. Liquidity refers to how quickly you can exchange whatever investment or saving you've made into cash to buy goods or services. So an example of something that is quite liquid would be like the balance you have in a traditional savings account. You can typically go to an ATM, withdraw cash from that account, and use it to buy goods or services very, very quickly in a matter of minutes. Whereas if you have a lot of your wealth still stored in the value of your home, a house is very illiquid. It's very hard to convert a house into cash to buy a good or service quickly. Typically, selling a home takes several months. So very different there. Savings account balances versus, say, a home. So when using those different options, we're going to evaluate all of them according to those three criteria. But we break down the options into two main categories. The first is saving. I'm defining saving as setting money aside in a safe place to earn modest interest. I have a star here next to it because the textbook uses saving and investing interchangeably at the beginning of it. I'm distinguishing between the two because investing is a high-risk option and saving is virtually risk-free. So saving is the way or the option that the textbook defines as balances in bank accounts. So very, very low risk, pretty low rate of return, and also very liquid, easy to access and easy to understand. The downside of having very liquid and low risk options for protecting and growing your personal wealth is that return is quite low. It's barely, if at all, going to beat the rate of inflation in most of the saving options we'll discuss. Investing has much more growth potential. That is when you use your funds to buy some sort of financial asset. Examples can include shares of stock, bonds, mutual funds, real estate, and the expectation is that those financial assets will increase in value over time, and therefore you will make more money. The big pro of investing is that it has a higher return than savings. The con is that it's higher risk, including the idea that you could lose your money instead of making money over time. And it's generally much more complicated. There's a lot of complex investment products that you can purchase, and people are coming up with new ones every day. So, should you save or invest? I can't make a recommendation for you one way or another. Again, that's for a professional to do. But I do have this NerdWallet article that I will link in the module that makes some general ideas of what to consider. So you might want to consider saving if you don't have an emergency fund, which is 1 to 6 months of your living expenses, think bills set aside in case there's an emergency like losing your job. Whether you set aside 1 month or 6 months depends on your risk preference, the level of responsibility you have, etc. Or consider saving if you're going to need the cash fairly soon, within less than 5 years, because savings can tend to be a little bit more liquid. Investing, on the other hand, typically takes place once someone has an emergency fund that they're comfortable with. Some people invest for the first time when they are offered an employer match on their retirement benefits, which we'll discuss a little bit later in the topic, after an individual has paid off high interest debt, or they have long-term goals that require a lot of cash. Again, the individual circumstances depends on the person. Before we dive into the steps of saving, we're going to define some terms. First is interest. So you might have heard the term interest in the context of loans on the borrowing side of our financial market, but it also works on the saving side. So it's money you owe when you're borrowing or are paid when you are lending/saving. The interest rate is that interest expressed as a percentage. So it is the price charged for borrowing funds over time, or the money that's owed to you for lending and saving funds over time. Typically, it's expressed as a percentage on an annual basis, or an APR. Compounding is when interest is added onto the principal, or the starting amount, and it's added on to past interest that was previously earned or accrued. So I like this second sentence as the definition of compounding: interest on interest. And understanding compounding is pretty important to understand the potential benefits of saving and investing over the course of your life. So we're going to jump over to an example real quick. So this table is in chapter 17 of your textbooks. There is a typo, which I have corrected here, so just be aware of that. So this example here shows what happens to $100 over the course of 3 years as it's earning 5% interest compounded annually. So let's say you put $100 into a savings account that earns 5% interest every year. Keep in mind this is a very high interest rate, and typical saving account interest rates, even high yield ones, are around less than 1% right now as of 2020. So you have $100, you put it in this account earning 5% interest. At the end of that first year, you'll have $105 in that account. The way you get that is you take the principal, the $100, and then you add onto that $100 the interest payment, which you get by multiplying the principal times the interest rate. Now remember, when you multiply using percentages, you have to convert them into decimal form. 5% in decimal form is 0.05. So 0.05 times 100, that's going to be $5. So that's why at the end of the first year, you have $105 in that account. You've earned $5 worth of interest. Now, if you leave all that money in the account, at the end of the second year, you're going to have a balance of $110.25. So your balance went up, but it didn't just go up by $5. This time it increased by $5.25. So it increased even more than it did the first year. The reason that happened is you earned 5%, not just on the principal, $100, but you also earned 5% of this extra $5 that was earned from the first year. You do that again year 3, that $110.25 balance increases by 5%. Now the total goes up to $115.75. The whole balance has increased now by $5.50. Pretty cool. The reason that happens, again, is because you're earning interest not just on the principal amount, but also on all the previously accrued interest. So that's why compounding is sometimes described as interest on interest. So not only do your payments grow over time, but they grow at an increasingly fast rate year over year. So this has the potential over many years of your life and at higher interest rates, depending on how you save or invest, than 5%, to accrue quite a bit of personal wealth over time. So much so that people sometimes refer to it as the miracle of compound interest. All right, annual percentage rate, we already discussed that briefly. It's the interest rate expressed on an annual basis. Annual percentage yield, you'll sometimes see advertised right next to the annual percentage rate because it's the amount of money or interest that will be earned in 1 year, including compounding. So the more frequently that interest is added into the account or it's compounded, the greater growth potential. So if it's compounded monthly versus weekly, there's a difference between that APR and the APY. FDIC stands for Federal Deposit Insurance Corporation. It's a federal program that protects the deposits of savers up to $250,000 per institution and per account type. So this is why I say and why I distinguish saving from investing. Saving is virtually risk-free, with the exception of FDIC going bankrupt. If you save with an FDIC-insured institution in an FDIC-approved account, even if that bank, that financial intermediary fails and completely goes out of business, this federal program insures your deposit up to $250,000 per bank, per account type. That is not going to be true of investments, and so this is a pretty good protection and why saving is low risk and generally low return. So the next step to save is to pick a financial institution, pick that intermediary. There's a few things that you might want to consider based on your personal preferences, but some things you might want to think about is first, that any bank you open a savings account with is member FDIC. It'll be printed on their website or on a sign outside if it is a brick and mortar storefront. Most banks are FDIC insured, but it's definitely worth double checking, especially if you are attracted to a new trendy startup bank. Not all banks are members. High earning, you want the account to have a higher APY. That way, the more money can be added on year over year. Typically, an online bank is going to offer a higher APY than something with a retail storefront for you to walk into. The reason for that being that an online bank doesn't have a building to maintain, rent to pay, light bills to pay, employees to run the store to pay, and that's why they typically offer a higher APY. Third is look for options with no monthly fee. Some do have monthly fees, some might be very low and you decide they're worth it because there's other customer service perks maybe, but there's plenty that don't have a monthly fee. They might require something else like a minimum balance or limited transfers, something like that. But avoid paying for your savings, otherwise it'll erode your interest quite quickly. Other than that, be sure to do some research, compare different accounts and different financial intermediaries. I will have some lists linked. So up here I have 2 different websites that just list their best of. This is the best high yield savings account as of November 2020 from a site called NerdWallet. This other site, Bankrate, has a similar list. They fluctuate over time. Just keep in mind, any website or anywhere you do research, the company that gives you these best of lists might have promotional deals with the ones that they rate highly. So always be a little skeptical and cross-check to get around that. All right, so when picking a savings account, most banks will offer these 3. So the first is a traditional savings account. Now, the traditional savings account with a typical commercial bank like your Regions, your Wells Fargo, they're going to have closer to the average interest rate, which is about 0.05% APY, which is quite low. And in the example that I did on the first slide about inflation and the Fisher equation, doesn't do a lot to protect you from inflation. So if you want something that mimics a traditional savings account, you might want to think about a high yield savings account, or an HYSA for short. So this one typically has higher rates and typically only is offered by online banks. But just to give you an idea, the difference between a 0.05% APY and a 1% APY, I have this simple savings calculator. So if we assume you have $1,000 that you want to save, if you were to put it in a traditional savings account, at the end of 5 years, the balance in that account will read $1,002.50. So you will have earned $2.50 worth of interest. Now, on the other hand, just to give you an idea, if you were to pick a high yield savings account, I'm just picking this one off the top of the list, they have an APY of 0.6%, which might not seem like much, but 0.6% over the same time period will amount to $30.36 worth of interest earned. So even though I'm talking about tiny fractions of a percent difference over long periods of time, that can amount to 10 or 20 times the earnings. So high yield typically is going to earn more money over time. The downsides of it, of using a high yield savings account relative to some other options, is they're typically only offered by those online banks. So if you like having a place to go to withdraw your funds, customer service people to talk to, those are less likely to be an option, and the rates change. High yield saving account rates just maybe a year ago or so were over maybe 2%. Typically now they're under 1% typically. That example I just found on the best of list had 0.6%, and that was pretty high up on the rankings. So they fluctuate. Another option is to open a money market account. A money market account is like a savings account, but it has more checking features. So funds in that account could be more liquid because you might have the ability to swipe a debit card linked to that account or to write checks. Sometimes they pay better interest rates than high yield savings accounts, but there's many that are just right on par. The downside of money market accounts is many have high minimum balances. It takes sometimes several hundred or several $1,000s that you have to maintain that balance of to keep the account within its certain parameters without racking up a fee over time. And rates on money market accounts, just like savings account, like high yield savings account, they're subject to change depending on the market rate. The last option is a certificate of deposit, sometimes called a CD for short. This is a savings account with a fixed term length and a fixed date of withdrawal of the savings, known as the maturity date. So basically, funds you put in a CD, you agree not to touch for a set period of time. There are different lengths that can be chosen from. Typically, the longer that you agree not to touch the money, the higher the interest rate is. So because the idea is you will not touch those funds for a fixed amount of time, those can offer the highest rate over time with that very, very low risk savings options. And once you open the CD, the rates are locked in. So if you can opt for a CD during a time when savings account rates are quite high, even if over the term that you hold that CD, rates fall over time, you've already locked in your rate, unlike with these other two accounts where the rate can fluctuate. The downside pretty much of CDs is that money is locked up. That's the whole idea. You can get a CD worth a few months, ranging to 5 years typically. But if you needed to withdraw that money early, there's quite a hefty penalty, right? So that's one reason people might not like it. It's not as liquid as the other two options. And they can typically have high minimum balances to open with. So those are the three options that most banks offer. There are others, though, as well. So before we move on to investing, just to summarize, your textbook says the main advantage for investors keeping their money in bank accounts, specifically savings accounts here, is you have easier access to your money, and money in the accounts is extremely safe because most of them are FDIC insured, though you should always double check. So according to our three criteria, they are low risk, low rate of return, high liquidity. Now moving into investing, all of the steps moving forward, Again, not recommendations. You should discuss them with a licensed professional, and they involve increased risk. But generally speaking, we're going to move through types of accounts that you can use to invest. You can open multiple ones. I have this hyperlink, so different investment accounts and different types and how they're treated. But I'm going to cover kind of broadly 2 types. Before we dive into the first step or any of the following ones, we are going to define some investment terms. So stick with me here. I know this is a lot of vocab. You've already heard me use the term asset before. It just means types of investment. I typically use the noun investment and the term asset interchangeably. It's those things that an investor buys, hoping that they will make money over time for them. They also have the potential to decrease in value and lose an investor money. So examples would be shares of stock, bonds, or real estate. Contributions. This is especially true of retirement accounts that we'll talk about. This is money placed into an investment account. A brokerage or a broker is a firm or an individual that sells investment services. They help manage, buy, and sell the assets for you. Typically a brokerage firm. Some examples include Charles Schwab, Vanguard, Robinhood, Fidelity, companies that you open an account with and then help you facilitate the trading, the investing. The Internal Revenue Service, or IRS for short, is the government agency in the United States that enforces tax law. We're talking about making money in this topic, so the IRS will have something to say about it. Vesting or vested, that verb means to have rights of ownership. We will discuss vesting in the retirement section. A withdrawal penalty is a fee incurred for withdrawing funds early from a locked account. So I discussed withdrawal penalties briefly with CDs. If you need to access funds from a CD early, there's typically a hefty withdrawal penalty. This is also sometimes true of retirement accounts. Capital gains. This is financial gain or money earned from buying an asset like a share of stock or a house and then later selling it for a higher price. Making a little profit, call that a capital gain if it's off of a financial asset. Stock, so the stock market, things like that. What does it mean when people talk about Apple stock, Amazon stock, all that stuff? It is a claim of partial ownership of a company. So if you own a share of Apple stock, you are part owner of the company Apple. Shares are portions of stock that a company issues if it's a public company. Generally speaking, as far as investments go, the rate of return for stocks is high. The risks are high, especially in the short run when we're talking year over year. And liquidity is typically pretty high for stock. You can typically sell a share fairly quickly. Shareholders, those are people who own stock in a company. And dividends are direct payments from the company that you own stock in. So if you own a share of a company's stock and that company makes a profit, they have options of what to do with that profit. They can put it back into the company and use it for future projects and future business expenses, or they can pay out some of that profit to their shareholders, in which case that's how you get a dividend if you are a shareholder. All right. So step 1 is to pick the type of account. Again, I'm going to link kind of broadly some general different types of investment accounts. The first one we'll cover is a standard brokerage account. It's sometimes called a taxable account or a non-retirement account. And again, all this information is coming from this article here. It provides access to a variety of investments. So you open the account, and then within that account, you hold the investments, stocks, bonds, mutual funds, etc. And any money that you earn from your standard brokerage account is subject to taxes from the IRS the year that money is earned. So you can earn money a couple different ways. One includes capital gains from an investment that you sell. So say you buy a share of stock at the beginning of the year, worth $100, and by the time November rolls around, it's worth $120, so you sell it. you've made a capital gain of $20, that $20 is going to be taxed in that corresponding tax year. Interest earned from your investments also subject to taxes, and those dividends. So dividends from the company, even if you don't sell the stock, if the company pays you a dividend, that's going to be taxable as well. There are no federal limits on how much you contribute or withdraw from standard brokerage accounts, though again, it's subject to taxes, so keep that in mind. And typically the money can be withdrawn at any time without withdrawal penalties. So, many of the questions I get from my students are about some investment apps that offer standard brokerage accounts. Sometimes they offer some other types of accounts, but there are increasingly a number of apps that are marketed towards new people who are new to investing, young people, college students, like Acorns, Robinhood, Stash. And I'm not saying these are good, I'm not saying they're bad, I'm just saying that is a lot of my students, in my experience, first experience with the world of savings and investment. It was also the first way I got involved. I opened a Robinhood account while I was still in college. I have since moved most of my money off of that platform, but I still have the account. Not saying it's good, not saying it's bad, but just some things you might want to consider with any of these apps or other types of brokerages for inexperienced investors that's marketed towards people who are just getting started. You might want to watch out for monthly fees. I know, according to this article that I will link, Acorns and Stash start at $1 per month if you open the account with a small amount of money, as most people getting started do. $1 a month might not seem like much, but if you're only starting off investing $100 or a few $100s, $1 per month can amount to quite a big percentage of that total investment, much more than, say, a traditional brokerage firm would charge. But then again, most traditional brokerage firms might require much more money to get started. So that's a trade-off to think about there. I don't know for sure the trading fees associated with these accounts, but different accounts might charge you a fee when you buy and sell certain types of investments, whether it's stock or options, or the type of investment that buys and sells might generate a different type of fee, so look out for that. Some of these apps offer margin trading. So margin trading is when you invest not using your own funds, but using funds that is borrowed from the brokerage itself. So this can add an extra element of risk to the whole idea of saving investing, because not only do you have the potential of losing your own money, but you have the potential of losing the brokerage money, in which case they can request even more from you than you originally intended to play with. Taxes. So savings and investment are subject to taxes. I have an article that I will link later to show you how a savings account is taxed. Typically, you will get a form from any interest earning account if you earn more than $10, but you should report all savings and interest earnings to the IRS each year you file taxes. But with investment accounts, the earnings tend to be, or potential earnings rather, tend to be higher than the 0.5 to 2.5% that we see with those savings account options I discussed. So the tax burden that corresponds to those earnings also tends to be higher. That people might not know that they're going to get a tax form from one of these brokerages when they start playing around in Acorns or something like that. Another issue that some professionals have with these apps is the idea that they may not educate the users of the risk, and that the people who get started using these apps don't understand the risk or understand the investments they're buying or selling. So, I just recommend that you don't buy things that you don't understand. If you couldn't explain it to somebody else how it works, generally stay away from it. Personally, I don't sell or I don't trade in things like day trading. I don't use strategies that I don't understand. They can be subject to special taxes, whether it's day trading, options trading, foreign exchange trading. Personally, if I'm not able to explain that to another person, what it is that I'm buying and selling, I stay away from it. I'm not saying you should or shouldn't, but generally understanding what it is you're doing is a good thing. And there's been some criticism that maybe some of these apps aren't fully doing that. All right, so aside from standard brokerage accounts, the other type of account that you could have in conjunction with that standard brokerage account is a retirement account. So retirement might seem far away for many of you, especially if you're a dual enrolled student, but accumulating personal wealth over time, as Chapter 17 explains, involves getting started early. So the earlier you get started, the more compounding you can take advantage of over the course of your life. So it's never too soon to think about retirement. Now, retirement accounts have special rules about taxes. Typically, the IRS provides some sort of tax incentive to try to encourage people to save for retirement by opening one of these types of retirement accounts. So there are many different types of retirement accounts. I will link to an article that explains in much more detail, but generally speaking, I am going to describe a traditional workplace 401k. Workplace retirement accounts can include 401ks, 403bs, 457bs. Again, I'm focusing on the traditional 401k. There's other types of 401ks out there, but I am talking about a traditional 401k here primarily. All of these fancy numbers and letters that might seem intimidating just refer to where in the tax code the rules about the accounts are listed. So don't let that throw you off. And then we'll discuss briefly individual retirement accounts, sometimes called IRAs for short. There are different types for these as well, but I'll kind of briefly discuss a traditional IRA and a Roth IRA. All right, so starting with the workplace retirement account, focusing on a traditional 401k. This hyperlink, again, will be on the linked pages, is a complete guide to 401k rules, about income limits, contribution limits, investment options, all kinds of stuff. It's a complete guide to 401ks. You could really read about 401ks for a very long time, could have a whole separate topic on it. So please don't take this one slide as all you need to know about 401ks. There's certainly much more to learn from the articles and from professionals about them, but it'll give you an idea, because when I got my first job offer and they were explaining 401k benefits, I just had no idea what they were talking about. So at least maybe this will give you a jumping off point. So the primary benefit to a 401k, a traditional 401k, is it can allow you to reduce your income tax the same year you contribute to that 401k account. So your first encounter with a 401k might be when you get a job after you graduate college. They'll offer you the option to opt into a 401k. Typically speaking, for moderate income individuals, when you put money into that account, that money is made with, quote, pre-tax dollars, meaning money you put in that account is not going to be subject to income tax when you file taxes for your earnings that year. So that's a big benefit. You get a little bit of a tax break if you contribute to that account. That's how the IRS tries to incentivize saving through 401k plans. Another big plus that some 401ks and some employers offer is called the employer match. So roughly half of employers offer this. They will contribute to your 401k account based on if you decide to opt into the account. So they typically match a percentage of the employee's contributions if they offer a match. So they might match, say, 100% of the first 3% of the employee's contributions. So just to give you an example of what that could look like, just move down here to where I have some white space. Let's say you get a job offer for $50,000 a year once you graduate Valencia here, and then your employer says, we'll match the first 3% of 401k contributions. That's typically, if they offer a match, what it is. So you have the option to set aside 3% of that $50,000. So you'll do 0.03 times $50,000, and you can set aside $1,500. That's 3%. If you, instead of taking that on your paycheck, across the course of the year of your employment, you put that into your 401k, then your employer will match it. They will also put in that $1,500, which means a total goes into your account of $3,000. And the thing about the employer match is they match however much you put in there. So if you put in 2%, they'll put in 2%. So this is a piece of advice from a certified financial advisor or planner. Don't ever leave free money on the table in the form of employer matching with 401k or 403b accounts. This is repeated often, but it's true. Again, your employer is going to match based on what you put in. So it might be hard to set aside that extra $1,500, but if you don't set it aside, you're not going to get the employer match and you'll be walking away from free money. So the employer match is a really powerful tool to increase your saving and investing over the course of your life. Typically, workplace retirement accounts, 401ks, can have fairly high contribution limits. For most people under 50, in 2020, the contribution limit was, I think, $19,500. It changes year to year, so quite high in terms of how you can reduce your taxable income that year and how much you can put in that account. The downsides of 401k plans is typically they offer limited investments to choose from, and the investments that the plan offers typically come with high fees. I will link a study to that. Most of the investments that you purchase through that 401k account might be investments that an ordinary individual would never select for themselves, but you only have options of what is offered through that employer plan, and most of them are not great. Now, that being said, if the employer offers employer matching, that can quickly outweigh even if there are not great investment options. So that doesn't mean that these accounts aren't valuable, but something to watch out for. Also, accessing 401k funds early can result in very hefty penalties. So to put it in perspective, if you needed to withdraw money from your 401k account early for some sort of financial hardship, if you are under the age of 59 and a half, typically, and say you needed to withdraw $10,000, you would have to pay income taxes on that $10,000, because remember, the contributions were originally tax-free. So now if you're withdrawing early, they're going to hit you with that tax, plus typically a 10% penalty. So if you need to take $10,000 out of your account, you might only wind up with $6,300 after taxes and penalties. It depends, again, on a person's age and what they're withdrawing for. There's some exceptions for financial hardship. There are some exceptions for certain pandemic type things. So that's why it's always good to double check with a professional if that's the case. But generally speaking, there's pretty strict penalties and withdrawal rules for 401ks. Also, sometimes the employer match that I was talking about earlier could be subject to vesting. So they might say that, well, employer matches aren't completely vested until after, say, 5 years, and that you're vested by 20% over the course of 5 years. That means your employer might match your 3% every year, but you're only entitled to owning those employer matches by an additional 20% every year. You're not 100% vested until, say, 5 years, 8 years. It just depends on the company, what they offer vesting options as. That means if you were to leave the job early, you're not going to take 100% of those employer matches with you unless you are 100% vested. So that can also be a little bit of a downside if the employer has a vesting schedule. And then once you're retired, when you begin taking distributions from a 401k account, they're typically taxed as income. So once you are retired, you don't know what your income tax rate will be once you're retired, but money that you take out of that account in retirement will be subject to whatever income taxes are at the time, in most cases. All right, individual retirement accounts. Again, I have linked a complete guide. There are many IRA variations. I'm just kind of loosely, with a broad brush, painting over two options. IRAs in general have the advantage that the individual can pick the brokerage, the company they open the IRA with, so they can pick a good company that generally doesn't offer fees or very low fees. They have more control over the investments versus only the ones that are offered by an employer. And you have more flexibility in picking your tax treatment, which is what these two different accounts, the main differences between the two listed below. And the downside of IRAs is they have relatively lower contribution limits. So I think with 401ks, it's about $19,500 for 2020. For most people, it's $6,000 for IRAs. So significantly lower contributions. Now, traditional IRAs versus Roth IRAs typically have to do with their tax treatment. I think of the traditional IRA as an option that is similar to that workplace 401k in terms of tax benefits. So it can offer the tax advantage now for the contributions, so reduces your taxable income that year, so you get the tax break today, and then you pay income taxes once you're withdrawing from the account in retirement. Has similar early withdrawal rules, your income taxes plus 10%. So the big draw of the traditional IRA, much like the 401k, is it can be cheaper to save for retirement in the short term because those tax breaks are offered. Now, a Roth IRA is a little bit different. So there is no tax advantage on contributions. So if you were to put money in a Roth IRA account, it does not reduce your taxable income in most cases that year. The trade-off is once you begin withdrawing from that account in retirement, those contributions plus any earnings it made over the year are tax-free in most cases. So this has the potential to lead to huge amounts of money saved if the money is invested well and invested early, because that compounding, that miracle of compounding, won't be subject to the taxes later. Roth IRAs also have more flexible early withdrawal rules. So the money you put into that account is made with after-tax dollars, meaning you pay income tax on any contributions to your Roth IRA. So if you needed to access those contributions early, typically you can access it without a penalty and without having to pay additional taxes on it. So hypothetically speaking, if an individual under 50 years old put $1,000 into a Roth IRA account this year, and let's say over the course of the next year or so, it grew to be worth $1,200, and that following year they needed to access some money from that account, they could access that original contribution of $1,000, but typically they can't access the $200 without incurring an additional penalty. Whereas with the traditional and with the 401k, accessing any of it is going to trigger that penalty plus taxes. So that's one of the big benefits of the Roth IRA. So it can be a cheaper option to save for in the long term. So to show you the potential gains of the Roth IRA, I have this cool Roth IRA calculator. So this description here, it shows what a powerful tax advantage way it can be to save for retirement. This is true for most people who start early. So let's say that someone starts their Roth IRA after they graduate with a 4-year degree. So let's say they graduate and go into the workforce at age 23. Let's stick with that original salary amount, $50,000 per year. Let's say they start with nothing saved up and they're single. If I hit done here, based on this criteria, let's suppose this individual starts contributing the annual max amount allowed to a Roth IRA account, $6,000 a year. If they retire at age 67 and invest in a well-diversified stock portfolio where it's not at all crazy to assume a 6% annual rate of return, this graph shows the difference between if they made their investments through a Roth IRA account versus a taxable account, say like a traditional IRA or a 401k. So the same exact investments, if they invest in that well-diversified stock portfolio with 6% annual return, the difference of the balance in the Roth IRA account to the taxable account is substantial, $1.27 million versus $870,000 in a taxable account. The reason for that is because this person got started saving quite early, they took advantage of compound interest over a long period of time, and because those distributions are not subject to income tax in retirement, the difference in the two accounts is quite high. So again, this will be linked so you can put in your own age, your own retirement age. If you waited until 70, right, there would be an even bigger balance. You can play with other things like your life expectancy to change these amounts down here and see what the tax savings could be. So Roth IRAs are a pretty powerful tool, have different tax treatment than the other accounts that I discussed. So that's why a lot of people opt in for those. Second, choosing a brokerage firm. So once you've picked an account, you need to pick a company to facilitate that account. So those are those brokerages I was discussing earlier. Charles Schwab, Vanguard, Fidelity, TD Ameritrade. There's a whole bunch of them you can research that offer different types of accounts. Some things you might want to look for with a brokerage are a reasonable or lower investment minimum, especially if you're getting started with not a lot of money. High quality trading tools, so checking on your investments, deciding to buy or sell them through the website or an app. Some offer educational resources or access to research. You should watch out though, some of them only offer educational and research on the best investments at a price. They may come with higher fees, not always though. But consider using free resources and not necessarily buying those through a brokerage that charges for them. There is a lot of stuff you can find online, like with these guys about what stocks to buy, if that's what you're doing, or what mutual funds to buy, things like that. Some fees to look out for include the brokerage fee. So fees charged by the broker, they could just be for having the account. So maybe they charge, $5 a month for opening a Roth IRA with them. That's just hypothetical, but obviously you want no fees or as low as possible on those so that you can keep as much as your money in your investments and not going to the account itself. Some have fees for inactivity, for access to research. That's those educational tools I was talking about earlier. Fees to access premium investments, so maybe some higher quality funds or something like that. So the less of those, the better. Trade commission, so those are fees that the brokerage charges for actually buying and selling investments or assets. So sometimes it's referred to as a stock trading fee, but they can charge them for not just buying and selling shares of stock for you in your account. So watch out for them. And then expense ratios. I'm going to discuss expense ratios in a little bit more detail in a later step, but typically when you purchase mutual funds and other types of investments, the expense ratio represents a fee that is charged based on the percentage of the money you have in a particular asset. So those, with any of those fees, the lower or if they don't exist at all, the better. Third is applying and opening the account. Again, I'm going to link the complete guide to all of these for you if you want to read more about them. For most accounts, though, at a minimum, you have to be 18 years older, have a social security number, and or tax ID. And if you're looking for a retirement account, you have to have earned income typically to be eligible to contribute to any of the retirement accounts listed. So for a standard brokerage account, in most cases, you don't have a contribution limit. You can pretty much withdraw your money without penalty at any time, though it may trigger taxes when you sell investments and take the money out of an account, right? Depending if there's capital gains, dividends, etc. For a 401k, the contribution limit is quite high for most people at moderate incomes under 50. Early withdrawals are typically a no-no and result in a penalty and taxes. IRAs combined have a $6,000 limit. That's for Roth and or traditional. Generally, for Roth IRAs, you can access the contributions early without taxes or penalty, but the earnings themselves can be subject to it. With Roth IRAs as well, there are income limits that begin at for individuals making $124,000 per year or more if they're a single filer. So once people start making above a certain income threshold per year, their ability to contribute to a Roth IRA might decrease. Traditional IRAs, very similar to 401ks in many ways in terms of withdrawals and penalties. So these are general contribution, income, and withdrawal limits. They do change depending on the year sometimes, so always keep up and research them. They also depend on your age. So for example, the IRA contribution limit is $6,000 for most people under 50. Over 50, it bumps up to $7,000 for 2020 for most income earners. So again, it depends on your age, it depends on your income situation, it can depend on your financial situation as far as penalties. So that's why it's always important to talk to a professional to figure out what criteria is correct for you. You find a lot of that information in these complete guides here, but don't take this at face value. It depends on the individual. All right, step 4 is choosing the investment. So you've picked an account, you've picked a company, you've applied, you've opened the account, you put some money into the account. Now what the heck do you do with that money? I could create a whole separate lecture video on this, but I'm going to paint with a broad brush here. To give you an idea of some terms and some options, evaluate them according to our 3 criteria. So I know this is a lot of words on this slide, but this is a very complex idea, and I just want you to have an idea of what these terms mean. So one option is you could buy some bonds. A bond is an investment that represents a contract saying that an entity or an institution owes you money at a set date. So you can buy corporate bonds, you can buy municipal bonds, those are bonds from a city or a town. You can buy treasury bonds from the US government. And so a bond is just a contract saying whatever you buy the bond from, they're going to owe you money later. It's going to pay certain amounts of interest. So according to our 3 criteria, your textbook says bonds can be low to moderate in terms of rate of return, risk, and moderate liquidity. You can buy them with different term lengths. So when I say low to moderate rate of return and risk, typically if you buy a bond from the US government, that's considered a pretty safe entity. There's low risk that the government will not be able to pay you back for your bond. Whereas a corporate bond is a little bit higher risk because there is a risk that the corporation might not make good on its IOU bond contract. So that's why this says low to moderate here on those risk and rate of return criteria. Next, we have bear market and bull market. It just reflects investor attitudes towards the market and what's happening in terms of stock prices and investment markets over time. A bear market means things aren't looking so hot. There's a decline overall in stock prices and people are feeling pessimistic about the economy. A bull market is the opposite. It reflects optimism and increasing prices and increasing wealth for investors, signals a sound economy overall. Maybe, and so if you've ever seen pictures of the Raging Bull statue that's on Wall Street in New York City, that's kind of the idea, the bull market, the Raging Bull statue. Blue chip is a way to describe a stock company with a history of good earnings. So a reliable, typically, company is considered a blue chip company, or a blue chip stock itself means the company's reliable and typically should be expected to increase steadily in value over time. Diversification is this approach to investing that an investor might spread their money across a wide range of different stocks and different companies, and they do that to reduce the level of risk overall. We'll talk about diversification in a little bit more detail a few slides later. A mutual fund is another type of asset. So like a share of stock or like a bond, you can buy a mutual fund as an investment with one of your accounts. So it is an investment program in which the investors pool their funds together And then they use those funds to buy a range of stocks and or bonds from different companies. And each investor that is in the fund gets a little slice of the fund assets. So what that does is it makes it easier for investors to diversify than if they tried to do it on their own, because they have access to the whole pool of investor funds to buy a variety of different things. Whereas if a single investor tried to do that on their own, it would take them a long time and a lot of money. So generally speaking, mutual funds over time have high rates of return. The risks are high and the liquidity is high, provided that the mutual fund or stock index fund is readily traded. Again, it depends on the fund itself. So typically mutual funds, they are considered higher risk, but they are considered lower risk than, say, buying an individual share of stock because it's more diversified. The Dow Jones Industrial Average, also called the DJIA, some people just call it the Dow or the Dow Jones. It's an average of 30 blue chip companies and their stock prices over time. So a lot of times when people say, oh, the stock market is down today, what they actually mean is that the Dow Jones Industrial Average is down in a given day, typically expressed as a percentage on whether those prices of the stock for those 30 companies went up or down over time. So it's a lot of the times used to reflect the health of the entire stock market, when in reality it just measures 30 companies, and there are thousands of companies that trade in the US stock market. So that's just one measure of the health of our investment market. Another type of investment is an exchange traded fund, also called an ETF for short. It's an investment that trades like an individual share of stock, but is made up of a blend of assets like a mutual fund. So many mutual funds will have a similar ETF tied to it in some cases, but instead of having to buy into the entire fund itself, you can buy a little slice of it like an individual share of stock. So they tend to be more liquid. The equity market is another term for the stock market. Equity just means ownership. So people might talk about housing equity, right? That's how much value of your house you own on top of outside of the mortgage. If they talk about equities in your investment portfolio, they're talking about stock ownership. So equity is a term that gets thrown around a lot, but means different things. An index is a tool to measure the progress of a group of financial assets with similar characteristics. So the Dow Jones Industrial Average, that could be considered an index. An index fund is a mutual fund that seeks to mimic one of those indexes. So there are many different indexes. Some mutual funds are focused on growth. Some mutual funds are focused on just mimicking an index. You could buy into an index fund that mimics the Dow. Market capitalization refers to the share price of a share of stock multiplied by the number of shares that are outstanding for a company. So it's kind of considered the total value of all of the stock for that given company. So the term large cap or mid cap refers to how many shares are out there and how valuable are they for a given company. The NASDAQ is the US market for buying and selling assets, and the NASDAQ is an index like the Dow. So there are different indices out there. One's portfolio is their collection of investments. The S&P 500, yet another index. This one tracks 500 US companies. The S&P stands for Standard & Poor's, which is a credit rating agency that's been around for quite some time. A ticker symbol is an abbreviation that is used to identify shares of an asset. So like a share of stock, a share of Apple stock is represented by the ticker symbol AAPL, for example. It's just an abbreviation. All right, so that was quite a bit to learn from with that investing vocab. So when choosing between those, you can think about the risk versus reward of different assets based on their asset classes. So with any investing, remember that you can lose your principal amount invested, but how risky an asset is depends on typically these three classes. So stocks are typically considered to have the greatest risk and the greatest growth potential. Bonds have more balanced risk and can provide steady income given their maturity dates over time. Cash is considered the lowest or no risk. That's money in your savings accounts, certificates of deposit, etc. So asset allocation refers to how an investor spreads their money across those three asset classes. So there are different approaches to asset allocation. Again, it depends on the individual, their age, their income level, their risk tolerance, how they want to allocate things. But generally speaking, some ways to think about it is the rule of 100. So the rule of 100 says that an investor should subtract their age from 100 to figure out what percentage of their investment should be in the stock market or their stock exposure, which is that greatest risk, but also greatest growth potential. And some people have said the rule of 100 should really be the rule of 110 or the rule of 120 as people's life expectancy has gone up over the years. But the general idea here, using the rule of 100, if someone is 25 years old, 75% of their investment should have stock exposure, or should be in the stock market, would be what the rule of 100 is suggesting there, or more if you use 110 or 120. And then as that person ages, right, if someone reaches age, say 50, maybe 50% of their investments are in the stock market now. So again, this isn't necessarily a hard and fast rule. In fact, I found articles where professionals debate that it has too much or too little stock exposure for people who are later in life. But it does express the idea that as you get closer to retirement age, generally you want to shift your asset allocation to lower risk, because if you're getting closer to retirement, you don't want to risk losing all those funds if there were to be a stock market crash or something like that. So that's why I think it's an illustrative tool to understand how asset allocation works, but not necessarily a strategy for everyone. A target date fund, that's a type of mutual fund that automatically adjusts the people who are invested in the fund, the asset allocation, as they age, from stocks to bonds to cash or very, very low risk bonds based on a set retirement date. So those are kind of cool because the fund itself adjusts how the fund's money is spent as the group of fund investors age over the course of their life. So that's kind of cool. So when you're deciding on asset allocation, I found this quote from this article that again will be linked useful. So I like metaphors. So this article says, if a metaphor helps, think of asset allocation as a car. Stocks acts as the engine. It gives your portfolio power and forward momentum. Bonds are akin to shocks. They absorb the impact and smooth out bumps. Cash is like the brakes, the thing you use when you need to slow or stop down or stop entirely. These different components work together to move you safely towards your destination. So the different asset classes, none are good, none are bad. They just have different trade-offs. This, I think, is my favorite slide of the whole video. So I know I've been talking for a while, but if you can click back in to pay attention here, I think this is a good idea. So these are some common kind of mantras or ideas in the investment world. First is that diversification is a good way to minimize risk. Now, there are many different ways to diversify, but generally speaking, many people will choose to invest their money in, say, a mutual fund, an ETF, or an index fund versus individual shares of stock because it minimizes risk. It doesn't put all their money based off of the fate of one company. Because when you buy an individual share of stock, all of the money that you are spending is dependent on the health and success of that one company you've bought stock in. Whereas if you buy into a mutual fund or you buy an ETF or an index fund, there are many companies that your money is going towards That way, if one company has a bad year or makes some poor financial decisions, all of your eggs aren't quote unquote in one basket. So, like I said, mutual funds, ETFs, which are similar to mutual funds, some are even almost exactly the same. They have derivatives of mutual funds offered in the form of ETFs. They're considered that higher risk, higher liquidity, higher return over time. But typically, the risks are minimized when it's diversified over time. There's also different ways to diversify besides just buying different companies. There is tax diversification when it comes to retirement accounts people talk about. So that's like saying having a 401k that provides tax benefits today, plus having some money in a Roth IRA that provides tax benefits in the future when you don't know what your income tax bracket's going to be like in retirement. That's one way to diversify. Spreading your money across asset classes, like was discussed on the other slide, another way to diversify. Typically, the idea of diversification is that an investor is better spreading their dollars across investments, across companies, across tax treatments, and that helps minimize risk as they invest and save over time. Going off of that, sometimes workplace retirement benefits will offer the option to buy the company's stock. And I'm not saying that is or isn't a good idea, but there are some articles out there that it kind of goes against the idea of diversification. An employee already depends on the success of their employer for their income because somebody at that company has to sign their paycheck. So once an employee is offered the option to buy that company's stock, not only are they relying on the success of that company for their own income paid, on a monthly basis or every couple weeks, however it is, they are also putting their investments based on the health of that company. So that is something to think about if your employer were to offer you stock options in the future. The second idea here is that beating the market can be tough. So I have this great quote here by Burt Malkiel, who has wrote a classic investment book called A Random Walk Down Wall Street that will be linked, and has sold over 1 million copies, has 12 different editions. It's a pretty successful book for investors. It's the idea that no one person or institution consistently knows more than the market. And so the idea behind this is it's really hard to beat the average market return with your own buying and selling of stocks or any other type of investment product. And this is because typically most stock prices follow, quote, a random walk with a trend. This is from your textbook. So a random walk just means on a given day, a stock price is just as likely to increase or decrease because the value of a share of a company's stock is dependent on future news of how that company is going to do. So if you wanted to beat the stock market, you would need to find a stock that was currently undervalued, buy it up, hope that it increased in value in the future, and then sell it for a profit that's greater than what the current market price is. That's really hard to do because people have a hard time predicting the future. So we say stock prices follow a random walk. The second part with a trend generally means that most stock prices go up rather than down over the long term. The increases are typically greater than the decreases over time. So the idea is that it's really hard for an individual to beat the market, and it's also kind of tough for professionals to beat the market as well, even though there are people who dedicate their entire careers to trying to beat the market. These are mutual fund managers and other brokerage professionals. The idea that stocks follow a random walk. Even financial professionals will not be able to choose stocks consistently that beat the market average. And your textbook says, if we look back over time, it's typically true that half or 2/3 of the mutual funds that attempted to pick stocks that would rise more than the market average actually ended up performing worse than the market average. So you should be skeptical of individuals who assert that they can beat the market and that you should trust your money with them. The problem with that is a lot of times, even if an individual professional can beat the market with investing money, sometimes you pay a premium for their services and all their research and all their work trying to beat the market. And with all of that work from, say, a mutual fund manager can rack up fees, can rack up taxes on an individual basis. If you're buying and selling frequently, there are capital gains taxes that you have to take into account. So that's why this next bullet point, generally a passively managed fund comes with a lower expense ratio than an actively managed fund. The lower those expense ratios are, the more money that belongs to the investor over a period of time. Which is why, and here I've repasted that quote from the textbook. Typically, going for passively managed funds are going to have lower expense ratios than the actively managed ones. That results in more take-home earnings over time. That's not to say every mutual fund with a high expense ratio is bad and everyone with a low expense ratio is good. It's just something to think about. The more you pay someone to actively manage a fund, the less money there are for the people who've bought into the fund overall. Which brings me to this article. Warren Buffett just won a 10-year $1 million bet. This is from 2018. So if you don't know who Warren Buffett is, he is possibly considered the most successful investor of all time. He owns a conglomerate called Berkshire Hathaway. And the idea behind this $1 million bet that he won over the course of 10 years has to do with the idea of active versus passive management. So, briefly explaining the bet from Buffett himself, he said, in Berkshire's 2005 annual report, I argued that active investment management by professionals in the aggregate would, over a period of years, underperform returns achieved by rank amateurs who simply sat still. I explained that the massive fees levied by a variety of helpers would leave their clients, again, in the aggregate, worse off than if the amateurs simply invested in an unmanaged, low-cost index fund. So, he offered a bet to any investment professional, $500,000 rather, that a low-cost S&P 500 index fund through the company Vanguard would outperform his opponent's group of at least 5 hedge funds over a period of 10 years. The results were that Warren Buffett and the passive S&P 500 index fund were the overwhelming winners over the course of the 10 years. And the reason for that is generally kind of what I talked here. It's really hard to predict the market, even if you're a professional. 2, even if a professional does beat the market consistently, frequent trading can rack up quite the fees and quite the expensive for all that work trying to beat the market. So, to give you an idea of how expense ratios can eat into earnings over time, I am going to compare the cost of 2 funds that I actually own. So I have 2 retirement accounts. One's a Roth IRA, where I have more control over the investments, and one's my employer's 401k, where I have limited options of what to choose from. So let's say the initial investment amount I put in each of these accounts is $5,000. These aren't real numbers. I'm just picking hypotheticals. The only real numbers I'm going to give you are the expense ratios of the 2 funds. And let's say every year I put $1,000 into my ownership of each of these funds. Let's say I'm going to continue to do this over the next 40 years, and both of them are generally invested in an index that tracks the bulk of the US stock market, which might have a long-run return of 7% or so, according to your textbook. So both of them should have the same performance over time because they're both generally targeted to the US stock market as a whole. However, the first fund through my Roth IRA has an expense ratio of 0.04%, which is considered very, very low. And the expense ratio of the asset that's in my 401k has an expense ratio of 0.48. So much higher than the first fund. I will say for the financial asset, there's some other benefits. It functions slightly differently than the first financial asset, but the performance is based on the same index. So if they both increase in value to the same amount over the next 40 years, the only difference between the two is what I pay per year in fees. I pay higher fees for the asset that's in my 401k. So that difference over the course of my life as I make investments will cost me about $32,000 for this more expensive fund. Now you might be asking yourself, why on earth do I own this fund at all? Well, I have an employer that matches some of my contributions, and that I've decided in this case outweighs the cost of fees that are available in my 401k, but that's not necessarily true for everybody. So watch out for fees and expense ratios of anything you buy. Be skeptical of anybody who tells you they can help you get rich quickly. It's really hard because of the random walk theory. Lastly, again, don't buy things you don't understand. It's so easy for people to get in over their head and to be susceptible to scams because these ideas are so complex. So always do your research, always talk to professionals, and be skeptical. All right. Once you've bought some investments, the idea is that if you really want to grow wealth over time, you should make disciplined and consistent savings and investments. So making regular payments into whatever account or accounts, you can have multiple, just depends on your preferences. There are many ways to think about this, but there is this no or low pain approach to taking any extra money you have and splitting it into thirds. A third goes towards the savings and investment. A third might go towards any debt you have, assuming that it's low interest debt, not high interest debt. If it's high interest debt, you might want to prioritize that more. And a third for fun as a reward for being responsible with your extra money. If you don't reward yourself every once in a while, you might lose motivation. But you could be very disciplined and just decide to split it half and half towards these things, or 100% towards saving and investing if you have no debt, which would be cool as well. So I know I said split it into thirds for any extra money. I'm not saying split it into thirds all of your income that you get on, say, a given monthly or weekly basis. So what do I mean by extra money? Because I don't know about you guys, but I could always use more money. So what do we think of as extra? Well, I get in the habit of thinking of 10% of my regular paycheck as extra. I get consistent and comfortable with the idea of making 90% of whatever it is I really make. And so if I get in the habit of taking that 10% and splitting it into these thirds, I don't miss it. So the sooner you can get into the habit of setting aside some of your regular paycheck, whatever percent works for you, the less likely you're to miss it later in life. When you get a raise, split the raise into these thirds. If you get a bonus, split the bonus into thirds. If you get a tax refund, this is a good one, right? If you typically get a tax refund from the government when you file taxes every year, split it into thirds. Yeah, use a third of it for fun and to reward yourself, but put a third to these other things as well. Any other money you find along the way, someone gives you a gift, or if you find money by trimming down your budget. Cutting out your Starbucks habit might save you quite a bit. Step 6 is to watch your money grow. Pick a few funds, set it and forget it. So picking some passive, broad-based funds might be the right approach for some people, though again, no recommendations for everybody. It depends on the individual. Consider making automated transfers. If you are in the habit of saving consistently, if you automatically transfer it, maybe you'll be less likely to spend it or overspend. Reinvest earnings over time. This is how you take advantage of that miracle of compound interest. That's how you get that big difference with that Roth IRA calculator over time. If you're constantly pulling any earnings you make off of your investments and using it to treat yourself, you're missing out on that compound interest potential growth. Check on your accounts every once in a while, but rarely, if ever, sell. This is another quote from Warren Buffett. Lethargy bordering on sloth should remain the cornerstone of an investment style. That's the idea that frequently buying and selling things racks up fees. So you want to pick something, set it, and forget it for the most part over time. Doing research and experimenting is always good. I'm always reading, always looking for new things to read, books, articles, etc. And then maybe, like I said, rarely if ever sell, but as you age, you might want to consider shifting asset allocation to less risk. Though, again, there's not one size fits all for everybody. If someone maybe is getting started with this later in life, they might want to pick a more aggressive than usual investment strategy to make up for lost time, which is why it's always important to talk to a professional. Last, this is pretty much 2 steps you can take to get rich the slow and boring way. So your textbook says most people can accumulate a large amount of wealth over time if they make 2 key choices. 1 is to complete additional training and education. Hooray, you're in my economics class, so you've already made this decision. You're on your way. And second, to start early in life. Everything in here I know was very complex. There's a lot of jargon, a lot of abbreviations, and a lot of terms that might seem intimidating, but don't let that stop you from getting started saving and growing over time. Don't be afraid to Google a term. If somebody is talking to you and explaining savings or investment and a term goes over your head, you can pretty much find all the information you need by doing a little bit of research and speaking to people who know what they're talking about for the most part. Though you should always be on the lookout for scammers. Make sure that the people you take advice from are licensed to give the advice that they're giving. So doing research should allow you to get started early and take advantage of the power of compound interest. So to combine these 2 ideas, let's look at a little example before we close. So here under the step 1, I have 2014 median household income where the main earner's highest level of education was a high school diploma, a 2-year degree, or a bachelor's degree. Let's look at the difference real quick between a high school diploma and a 2-year associate's degree, which is offered here at Valencia. The median household income goes up by about $7,436 by completing this degree. If an individual were to take that $7,000, what was it I said? $436, and invest it in a well-diversified stock portfolio until they retire, let's say over the next 40 years, and over the long run, that stock portfolio earns them about 7% annually. That $7,436 will be worth $111,350.07 by the time they retire. That's pretty incredible. Now, over $100,000 isn't going to make somebody a millionaire, but this is the potential growth of making the choice to save and invest some extra money, right? Because their income went up, right, by this amount exactly once. Just the first year their income goes up. If instead they were a little bit more disciplined and maybe they could save $400 a month moving forward. So they make that contribution the first year, and then every month after that, they continue to put $400 into a well-diversified stock portfolio. By the time they retire, they're a millionaire. So a lot of the time, saving and investing requires discipline, patience, practice, but people can accumulate large amounts of wealth by making these 2 key choices. So I hope that this has given you a launching point to conduct your own research. Again, I urge you not to make any big financial decisions until you talk to somebody who can understand the circumstances of your situation, but I hope this will inspire you to start thinking about doing that research. Let me know if you have any questions.